It is an ordinary weekday morning. You are half awake, holding a warm cup, thinking about school drop-offs, work messages, and the usual rush. Then your phone vibrates. You see an email alert. The subject line looks official and cold. It mentions a penalty and something about a foreign account. In that instant, your stomach tightens because you know you did not do anything shady. You worked. You paid your taxes. You tried to do everything right. The only thing you can think about is that small account back home that you barely touch. Maybe it is an old savings account you opened years ago. Maybe it is a joint account with a parent. Maybe it is an account you can sign on for family reasons, but the money is not even yours. You always assumed it was private. You assumed it stayed over there. And now the message in your inbox is telling you that this one detail might cost you a massive amount of money. And depending on your situation, it might also create immigration problems you never saw coming. If that sounds like your life, or like the life of someone in your family or community, do not click away. The biggest mistake people make is either freezing and hoping it disappears, or rushing to pay or file something blindly without understanding what they are doing. In the next few minutes, I am going to walk you through what this situation usually is, why it traps so many honest immigrants, and the safest way to respond so you protect your money and your future as much as possible. I have helped break down these rules for people who are terrified and overwhelmed, and I can tell you this: most damage comes from misunderstanding, delay, and panic decisions, not from the original account itself. First, let us get one thing clear so you can breathe. Having an account in your home country is not automatically a crime. Sending money to family is not automatically a crime. Owning assets outside the United States is not automatically a crime. The problem usually starts when a reporting rule applies and you did not realize it applied to you, and then time passes, and then the government believes you ignored it. So the goal here is not fear. The goal is clarity and action, because clarity is what reduces risk in situations like this. Now let us talk about the trap that catches people who are trying to live normal lives. There are 3 reasons so many immigrants get hit with foreign account reporting issues. The first reason is the $10,000 misunderstanding. People hear a threshold, they think it means one account, at one moment, at year end, sitting there like a test you either pass or fail. That is not how it works in many cases. The second reason is that the data flow is not what it used to be. Many people still live in the old mindset of, how would they ever know about my bank back home? That mindset is outdated. And the third reason is that immigration processes can magnify tax issues, because certain applications involve questions about truthfulness and compliance, and if you answer incorrectly, even by accident, you can create a separate problem on top of the financial one. So you have to treat this like a real situation, not like a paperwork nuisance. Let us start with the $10,000 misunderstanding in plain language. There is a reporting requirement that applies if the combined total value of certain foreign financial accounts goes above $10,000 at any time during the year. The key phrases are combined total and at any time. Combined total means you do not look at each account alone. You add them together. At any time means you do not only check the last day of the year. You look across the whole year and ask whether, on any single day, the total of those accounts was above the threshold. This is where normal people get burned. A person might say, I never keep 10,000 in any one account, I am safe. But then you find out they had 3 accounts that overlapped for a short period. Or they moved money from one account to another and for a day, both accounts were high at the same time. Or a family member deposited money temporarily and then withdrew it later. Or there was an insurance policy with cash value sitting quietly in the background. The math that matters is the highest combined value at any point, not the average, not the end of the year, not what you have today. Picture a realistic example. You have a checking account in your home country that usually sits around $3,000. You have a savings account that sits around $4,000. You also have a fixed deposit or an account connected to an insurance policy that can be cashed out, and it is worth $3,500. You never think about them together because they are in different banks and different apps. But the total is $10,500. If that total happened even once in the year, reporting may be required. And here is the part that shocks people. It does not matter if the balance dropped later. It does not matter if by December you had almost nothing there. The question is whether it crossed the threshold at any time. That is the first layer of the trap. The second layer is how information moves today. A lot of immigrants still assume the United States cannot see foreign banking. That was a common belief years ago. Today, many financial institutions outside the United States share information through international compliance frameworks. One of the most well-known is called FATCA, which stands for Foreign Account Tax Compliance Act. The details can get technical, but the simple idea is this. Many foreign banks identify account holders with ties to the United States and report certain information through channels that ultimately reach United States authorities. That does not mean every account is instantly visible in perfect detail, and it does not mean every person gets flagged. But it does mean the old advice of, "they will never know," is reckless. Many people do not get caught immediately, so they assume they are invisible. Then a notice arrives years later, and suddenly it is not just 1 year, it is multiple years, and the risk multiplies. So you have to operate as if disclosure is discoverable, because in many cases it is. The third layer is the one that can hit your life plans hardest. Immigration consequences. If you are applying for certain benefits, including naturalization, you may be asked questions about whether you have complied with tax obligations and whether you have ever failed to file required forms. You may also be asked questions under oath. If you incorrectly answer those questions, even if you were confused, it can create credibility issues. Immigration officers can look for patterns that suggest a person is not being truthful. Tax compliance is not the only factor in a good moral character analysis, but it can become a problem if it looks like you ignored legal duties or if the government believes you misrepresented facts. I am not saying every mistake will destroy an application, because outcomes depend on details, timing, and context. But I am saying you should treat it as serious, because the cost of handling it casually can be huge. Now let us ground this in the actual reporting systems, because there are two major buckets people confuse. One reporting requirement is commonly called the Foreign Bank Account Report, often shortened to FBAR. It is filed electronically, and it is not the same thing as your income tax return. It is generally required when the combined value of foreign financial accounts exceeds $10,000 at any point in the year. Another reporting requirement is a separate form attached to your regular tax return, often associated with FATCA reporting. That second form has different thresholds that are often higher, and it also covers a broader category of foreign financial assets, not just bank accounts. Many people assume one replaces the other. In many cases, it does not. You might need one, or the other, or both, depending on your balances, your filing status, and what kind of assets you have. Here is a clean way to understand the difference without getting lost. The Foreign Bank Account Report is mainly about foreign financial accounts, meaning accounts where money is held or managed, and the trigger is the combined value crossing the threshold at any point. The tax return attached form is about specified foreign financial assets, which can include accounts but may also include other financial holdings, and its thresholds depend on whether you live in the United States, whether you file single or jointly, and what the total values are at year-end and at any time. The exact thresholds can change based on your situation, and you should verify them for your filing status and residency. But the big idea is that these are two separate systems with two separate rule sets. Treat them like two locks on two doors. You check both doors. Now we need to talk about the part that creates tax bills on top of reporting penalties: worldwide income. Many people are shocked to learn that if you are a United States citizen or you are treated as a United States tax resident, the United States generally taxes you on worldwide income. That does not mean you always pay double tax, because there are tools like foreign tax credits and treaties in many cases. But it does mean you have to report the income. Interest earned in an overseas account may need to be included. Rental income from property abroad may need to be included. Business income from certain foreign involvement may need to be included. Again, this is not about you doing something wrong. It is about the United States being aggressive about worldwide reporting for people it considers within its tax system. And if you do not report, it can look like concealment, even when it was confusion. Let me pause here for a quick recap so you do not get overwhelmed. The danger comes from three things: misunderstanding the threshold calculation, underestimating how discoverable foreign accounts can be, and letting a tax reporting issue spill into immigration credibility. The protection comes from three things: doing the math correctly, filing the correct forms, and fixing mistakes proactively rather than waiting for a notice. Now, I want to give you a realistic story in the middle, because this is exactly how it happens in real families. Imagine a couple who immigrated 5 years ago. They are busy. They work long shifts. They send money home. One spouse has a joint account with a parent because the parent is older and needs help paying bills. The couple does not think of it as their money. They never use it. They assume it is not their issue. During the year, their parent sells a small piece of land and deposits the proceeds into that joint account for a couple of months. The balance jumps. Then the parent uses it gradually for family needs. The couple never tracks it because it is not their daily banking. At tax time, they file a normal return. No mention of foreign accounts. No mention of any reporting, because they genuinely believe it does not apply. 2 years later, they decide to apply for citizenship. They answer the questions the way they think is correct. Then, a year later, a letter arrives about an unreported foreign financial account and a potential penalty. Now it is not just about money. It is about explaining a past mistake while in an immigration process. That couple did not wake up and decide to hide anything. They walked into a system that punishes silence, even when the silence came from ignorance. So what do you do if you are watching this and you suspect you might be exposed, or you already received a letter? Here is the safe approach. You need an action plan that is calm, organized, and fast. And yes, I am going to give you an action plan in simple steps, but I am going to say them in a way you can follow immediately, without feeling like you need a law degree. Also, very important, this is educational information, not individualized legal advice. Your facts matter, and if the amounts are large or you have an immigration case pending, professional guidance is usually worth it. First, you gather your inventory. That means you sit down and write down every foreign financial account where you are an owner or you have signature authority. Signature authority means you can control the account even if the money is not yours. This includes personal savings, checking, joint accounts, and in many cases accounts you can sign on for a family member. It can also include certain foreign accounts tied to investments or insurance products with cash value. People forget these because they do not feel like a bank account, but they can count depending on the details. Your goal is not perfection in 1 minute. Your goal is to stop guessing and start listing. Second, you find the highest value during the year, not the end of the year, not the current value, the highest value at any point. For each account, you look for the maximum balance during the year. Then you convert it into United States dollars using an appropriate method consistent with reporting guidance. Then you add the maximums in a way that reflects whether at any point in time the combined total exceeded the threshold. If you cannot get daily combined totals, you take a conservative approach and identify likely peak overlap periods. The point is to answer one question honestly. Did the combined value cross the threshold at any time? If yes, you treat it as reportable. Third, you separately evaluate whether the broader asset reporting threshold applies to you for the tax return attached form. This is where many people need help, because it depends on your filing status and whether you live in the United States or abroad, and what counts as a specified foreign financial asset. This is also where you can accidentally leave out things like foreign brokerage accounts, certain foreign partnership interests, or foreign stock holdings if you do not understand the definitions. The goal here is not to panic. The goal is to check, because the penalty risk can rise when multiple forms are missing. Fourth, you check your income side. Did those accounts earn interest? Did you receive dividends? Did you have rental income abroad? Did you have income from a business arrangement abroad? If yes, you need to ensure it is properly reflected on your tax return. If you paid tax abroad, you may be able to claim credits depending on your situation. Many people think credits erase the requirement to report. They do not. Credits can help reduce double taxation, but they do not replace disclosure. Reporting is still the backbone. Now here is the fork in the road, And I want you to pay attention because this is where people choose poorly when they are scared. If you are current and you have not missed previous years, your job is to file correctly now and keep clean records. If you are already late, meaning past years required reporting and you did not file, your job is to fix it before the government contacts you in a way that removes your options. There are programs designed for taxpayers who made non-willful mistakes, meaning they did not intentionally hide information. One widely discussed pathway is the streamlined filing compliance procedures. The details matter a lot, including whether you live in the United States or abroad, and whether you can certify that the failure was non-willful. In many cases, these procedures allow people to catch up with fewer penalties than they would face if the government believes the behavior was willful, or if the government contacts them first. But you have to handle it carefully, because the certifications are serious and must be truthful. This is where working with a tax professional experienced in international reporting can be the difference between a clean fix and a bigger problem. If you already received a notice, you need to slow down and not self-sabotage. A notice does not always mean the worst-case penalty is guaranteed. It often means the government believes there is a compliance issue and wants a response. Your response matters. People make the mistake of ignoring it because they are afraid. That usually makes things worse. People also make the mistake of sending a messy reply with half facts. That can create inconsistencies that follow you. The safer approach is to gather records, understand what is being alleged, and respond within the deadline in a structured way, ideally with professional help if the amounts are significant. If you pay immediately without understanding, you might pay more than necessary, or admit things in a way that limits options later. If you do nothing, you risk escalation. The goal is controlled action, not panic. Now let us talk about the immigration angle more directly, because this is the part that people rarely connect until it is too late. If you are planning to file a naturalization application or you have an application pending, you should treat tax compliance like a foundation. You want your filing history to match reality. You want your disclosures to be accurate. You want any past mistakes corrected before you sit in an interview where you may be asked to confirm your compliance. It is not about being perfect. It is about being truthful and consistent. If you correct past reporting mistakes properly, and you can document that you did so, that is generally a better position than pretending nothing happened, and then being confronted with data you did not disclose. Again, outcomes depend on facts, and an immigration attorney can advise on how tax compliance issues should be presented, especially if you have a complicated history. But the principle is simple. Clean it up before the interview, not after you get questioned. Let me give you a mini recap again because we are deep in the topic. Your job is to know whether you crossed the reporting threshold for foreign accounts, know whether you triggered the tax return attached foreign asset reporting, ensure worldwide income is correctly reported, and if you are behind, use the correct catch-up pathway before you get contacted in a way that removes the benefits of voluntary compliance. Now I want to address a dangerous myth that keeps hurting people. The myth is, I will transfer the money out and close the account, and then it will be fine. Closing the account does not erase past reporting requirements. Reporting is based on what happened during the year. Another myth is, it is my parents' account. My name is just there, it does not count. If you have signature authority or ownership, it may count. The definition can be strict. Another myth is, the amount is small, they will not care. Sometimes smaller accounts still create penalties if the reporting rule applies. And sometimes what looks small to you can look large when penalties are calculated across multiple years. So do not rely on myths, rely on the checklist. Now let us move into the clear action plan that you can follow today. I am going to speak it in a way that you can replay and do it in one evening. You sit down and create your foreign account folder. This can be digital or paper. You include account statements that show maximum balances during the year for every foreign account where you have ownership or signature authority. You include details like bank name, account number, account type, and the country. You also note whether the account is joint and who the other holder is. Then you compute the maximum combined value and you determine whether foreign account reporting is required. Separately, you list all other foreign financial assets that might trigger the tax return attached form, like foreign brokerage accounts or other financial holdings. Then you gather your foreign income documents, including interest statements and rental records if applicable. Then you decide whether you are current or late. If you are current, you file correctly on time. If you are late, you look into the appropriate voluntary correction pathway, and you do it before you get contacted. And you do not guess, you do not improvise. You use a professional if needed, especially if you have multiple years missing, high balances, or an immigration application coming up. Now let us talk about the words you should use in your own head to avoid making a bad decision. The words are, I am not a criminal, I am a person learning a system. That mindset matters because panic makes you hide, and hiding is what turns a reporting issue into something much bigger. The government often cares less about the fact that you had an overseas account, and more about whether you complied once you knew you had to comply. Intent matters in many enforcement contexts. Non-willful versus willful is a major dividing line. You do not want your behavior after you learn about the rule to look like avoidance. You want it to look like responsible correction. Now here is the second realistic story near the end, because I want you to see how the right move looks in practice. Imagine a man named Khalid who has lived in the United States for 7 years. He is saving for a home. He has an old account in his home country that his relatives sometimes use to collect rent from a small property. He thought it did not matter because the money is used for repairs and family support. One day he watches a video like this and realizes the account may have crossed the reporting threshold during a month when rent piled up before it was distributed. He feels sick because he is about to file his citizenship paperwork. Instead of ignoring it, he does the boring work. He gathers statements, identifies the maximum balances, and talks to a tax professional who understands international reporting. They determine he missed prior reporting, but his situation looks non-willful because he had no knowledge and no intent to hide. They use a recognized procedure to catch up and document everything. When Khalid later files his immigration application, his answers match his corrected record. If he is asked, he can explain what happened and show that he fixed it proactively. That does not guarantee a perfect outcome in every case because every case is unique, but it typically puts him in a far stronger position than if he had done nothing and hoped for luck. Luck is not a strategy when penalties and immigration status are on the line. Now I want to be very honest about risk, because you asked for straight talk. The risk factor here can be high if you ignore it, because penalties for missing foreign account reporting can be severe, and repeated years can compound. The risk factor can also be high if you lie on an immigration form or under oath, because that becomes a separate issue beyond taxes. The risk factor is usually lower if you correct mistakes voluntarily and document your correction, especially if the failure was genuinely non-willful, but you still have to do it correctly and truthfully. The stupid move is pretending the government cannot see anything and doing nothing. The smart move is doing the inventory, doing the math, filing correctly, and catching up through proper channels if needed. Let me give you 3 simple truths to keep in your head when this video ends, because you will forget details but you can remember truths. First, thresholds are often based on combined totals and peak moments, not what you have today. Second, foreign account data is more discoverable than people assume, so secrecy is a fantasy plan. Third, if you have immigration goals, tax compliance is not just money, it is credibility. Those 3 truths will keep you out of most trouble. Now I want to end with a calm but urgent push. If you have accounts back home, do not treat this as a problem for later. Later is how penalties grow. Tonight, do the inventory. This week, gather statements. Before you file your next return, make sure the right forms are included. If you realize you are behind, do not hide. Use the proper voluntary correction route and get help if you need it. And if you know someone in your family or community who sends money home, who has joint accounts, who keeps savings overseas, or who is about to apply for citizenship, tell them to watch this. People do not get hurt because they are bad. They get hurt because no one explained the rules clearly. If you want more videos that break down dangerous paperwork traps in plain language and show you how to protect yourself, subscribe, and in the comments tell me what country your foreign accounts are in and whether you are filing as single or married. because I can make a follow-up that explains the most common reporting mistakes for your specific situation and what records you should be saving before tax season hits.